Our next guest says that the market is now in a forced rotation that could lead to a year-end rally. For more on what has changed, let's bring in Fedwatch Advisors Ben Emons. Ben, great to see you. So this forced rotation into what you say?
Yeah, it's happening between Max 7 and small caps finally, Mel. I think that this, as everyone's talked about on the desk, all the reasons why we're suddenly having an environment of, let's say, total certainty, which is interesting, right? We always talk about uncertainty and tail risk and what could go wrong and volatility spikes, but it seems to be taken off the table. And when certainty, so it allows this market to rotate. I was looking today at that graph between Max 7 and small caps really start to narrow towards each other in terms of return. So, you know, Max 7 coming down in return and small caps going up. But I also noted there's another thing going on, and that's this red sweep idea that seems to be taking hold of the markets, meaning people are trading sort of the idea that, okay, I don't know who will be the president, but it probably will be a Congress that's Republican that's going to be market friendly, if anything, right? Lower corporate tax rates and these tariffs, that we'll see what happens with that. So yet the market seems to be trading that red sweep and enforcing this rotation as that graph shows. So it's an interesting dynamic. I think this sets us up for that year-end rally.
What is in this red sweep? Is this the Strategas red sweep basket? And I think that there's some steel names in it, things that could benefit from a tariff scenario. But when do you sell this basket once the news happens?
Yeah, I think that is the question because, you know, again, to the credit of Strategas, they put that together, different names in there, maybe somewhat selection bias, but it's the idea of that these companies can withstand tariffs and also benefit from some other policies from Trump against lower corporate tax rates. And, you know, we all have to wait for the election ultimately as the outcome, but I think it's really about what will the Congress really be made up of. And see, if that expectation is right, that basket actually could continue to rally because it will, like in 2017, will price in this policy of, you know, how Trump is going to put it into the economy. Right? If you listen to Howard Lutnick, political maybe, but the ideas of like trying to rebalance the economy, more inward investment, that basket will then really outperform. So I don't think you want to sell it here. You want to kind of ride it into the next year.
Does it make you nervous to the point of some of the traders here on the desk, Ben? Does it make you nervous, though, that people are coming around to this idea that these tail risks are being priced out of the market at this point, and that people are willing to say, you know what, those concerns are no longer concerns, and that is becoming consensus?
Yeah, and that's the complacency that we always have to keep in mind. I mean, I think what happened yesterday in the Middle East was significant, you know, in terms of how Israel takes control of the war in Gaza and has not attacked the energy facilities in Iran yet, but that tail risk remains there because it's a fluid situation. Even though the oil market took it as the tail risk is off the table, there's not going to be a supply disruption. That doesn't say that could happen. So we do have to be mindful of complacency. We also have to think about the way the VIX has behaved, for example. We had the big spike already in August with this carry trade. We were supposed to have a spike in October where how the VIX futures were priced this week and has rolled off. So we're a bit of a low complacency environment as we enter that against this macro backdrop as well describing. Good economy accelerating, with potentially this red sweep unfolding, having an important impact on the economy. So be mindful of the tail risk. I don't think they're gone. No.
So how do you reconcile gold's move with all that is positive in the markets and low volatility?
That's an amazing one, actually, because, you know, on the one hand, you think that this is really the uncertainty play. I mean, gold appreciates on uncertainty and appreciates maybe on inflation, but it's really about, I think, people looking for the alternative asset. You know, that gold has been really well strongly correlated with the S&P over the last year. And we talked about it in a previous show. It seems to be really lockstep. Then it's about, I think, an alternative to other commodities, say oil and iron ore, which has been affected by weak China demand. That China's been buying gold. And lastly, there is volatility in bonds. So gold seems to be also maybe somewhat of a hedge against bond volatility that could appear as data comes out stronger than expected. So I think those are maybe the reasons why this gold price is up, and yet it supports the market, interestingly, you know, with this view of no uncertainty having a higher gold price.